Okay, so Chapter 1, Learning Objective 3 introduces us to the four important financial statements that you'll be learning in accounting. We are focused on the first three, okay? You will be learning about the cash flow statement down in Chapter 12 in Accounting 102. We go into detail on the cash flow statement down the road. It's a little bit more of a complex statement, and it just takes a little bit of time to get used to. And so it's best to actually save it for later on. But what's critically important up front is to know the three financial statements that are listed right up top here. So the first one is the income statement. The income statement is the only statement that tells owners whether they actually had a profit or a loss for a period of time, okay? And that's important to know. The income statement measures a period of time. The shortest period of time it'll measure is a month. The longest period of time it'll measure is 12 months or a year. So income statements are prepared every month. They're prepared every 3 months. We call a 3-month period a quarter because it's a quarter of a year, 25% of a year. And then the annual statement at the end of a 12-month period of time. So income statements are extremely important, and they're the very, very first financial statement that's done. What you need to know about the income statement are there's two major types of accounts that live and belong on the income statement. The revenue account, revenue accounts, and the expense accounts, okay? And we're gonna look at specific ones in just a moment. Revenue is what we sell, is derived from selling what we have to sell to the customers. So if we sell, if we have, say, a hair salon, we will sell our hair styling services. Every time someone comes in and gets a haircut or a hairstyle, we are earning revenue. We're charging them a price, but the prices that they pay are our revenue. We might also sell various products, hair-related products, and so those would be when a business sells a product, that's what we call sales revenue. When a business performs a service, like does your hair, for example, in our hair salon, that would be service revenue. So we try to label the revenue from where we actually get or earn the money from. If we sell a product, it's sales revenue. If we sell a service, it's a service revenue. On the other side, we had to spend money. Of course, we measure that on a monthly basis, remember. On the other side of things, we had to spend money to provide those services to clients. And so we categorize what we spent that month as expenses. And our hope is that as we do the income statement, we have more revenue than we have expenses. And that's because if we have more revenue than expenses, that means we earned a profit for that period of time. And a profit is what businesses are really looking for. That's their goal at the end of the time period. They want to make sure that they're selling a lot more, their expenses are low, and they're keeping the excess revenue is profit. So revenue is extremely important. It's what it comes from what the businesses sell, and it has to cover all their expenses, and there has to be some left over. That's the profit of the company. So the income statement shows revenues minus expenses will give a company a profit. The profit specifically on an income statement is called net income. So there are three interchangeable terms. Net income means the same as profit. Profit means the same as earnings. And so those three words, net income, earnings, profit, they all mean the same. They're very much interchangeable. And so once you get that down, you'll understand that the net income or the profit then has to, at the end of a period, then has to the owners own the profit, and then they have to decide what to do with it. So if you had a profit from your business, what would you want to do with the profit? Well, most people would say, let's keep it in the business and reinvest it in the business so we can grow the business. And most people would agree with you. However, the owners, in some cases, can choose to take some of the profit out of the company to their personal bank accounts. For a corporation, when a corporation shares a portion of its profit with the owners, that's what a dividend is. And so the retained earnings statement will show us how much of the profit of the company was retained. The word retain means to keep in. Well, what else can happen to the profit? Some of it can go out in the form of a dividend. And so the retained earnings statement just tells us, now that we know what the profit is of the company, how much of that profit is retained, the rest of the profit has been sent out in the form of a dividend. The retained earnings statement is simply a summary of that. This is what the profit was of the company for this month. This is how much of the profit went out of the company in the form of a dividend. The remaining portion has been retained, kept in the company, retained profit. The owners own the profits, and so retained earnings is its own account on the balance sheet under stockholders' equity, because the stockholders' equity are the owners' accounts. There are two owners' accounts that you have become familiar with so far, and that's the only two you're going to get familiar with in financial accounting, is the common stock account and the retained earnings account. They both represent owners' interest. Common stock is when owners put money into the company to start it. They get shares of ownership. That's what common stock represents, shares of ownership. The retained earnings account is the profits of the owners that have been kept in the company for reinvestment. Both the income statement and the retained earnings statement measure the same period of time. And that's because you need to figure out the income statement first before you can do a retained earnings statement. The retained earnings statement, again, is simply the story of the profit that came from the income statement for that period of time. Again, periods of time are very important. We measure every month, we measure every quarter, we measure every year. After we do the income statement and the retained earnings statement, the last statement we do is the balance sheet. And unlike the income statement and retained earnings statement, which measures a period of time, the balance sheet is simply a financial selfie of that day. So when you look at a balance sheet, as we will shortly, there's just a date on it. And that's because you're looking at assets, you're looking at liabilities, you're looking at equity accounts. Those are the three major accounts that are on a balance sheet. And say, the first asset account is always cash. So you're going to have to just look and see how much cash I have that day and put it down. You can't be making up numbers over a period of time. It's just not how a balance sheet works. It's very specific to the day, unlike the income statement and retained earnings statements, which are over periods of time. Okay. And again, we don't have to worry about the cash flow statement right now, but it tells us how the changes of cash throughout the year. So if we started with this much cash in January, and we have this much cash at the end of December, at the end of the year, this is how all those changes happen to cash. That's really all it tells us. It's a little bit detailed, and we'll deal with it in Accounting 102. All right. Yes.
So for like the income statement, do like publicly traded companies have to disclose that information?
Yes, publicly traded companies have to disclose all financial information, including management decisions that have financial implications.
Okay. So, and then that would be like basically like based on like the fiscal year, or is there like just certain times throughout the year that they would have to?
Anytime they have, anytime they have to report a decision that impacts the company needs
Okay.
to be made public. Yeah,
Okay. Thank you.
you're welcome. All right, so here's Sierra Corporation. If you read your book a little bit, Sierra Corporation is the fictitious company in the first used in the first 4 chapters of the book, and it's a they do tours of the Sierra Nevada region out in California. Apparently, when it's not on fire. And so basically speaking, they give hiking tours. That's what they do. That's the only thing they do. That's what they sell. So the revenue account that they use to show that they are selling a service by giving tours is called service revenue. Service revenue is a specific name of an account. Revenues are simply a broad category of account. What will you see on the accounting record of a business? You'll see service revenue. You'll only see accounts. There won't be revenue. It'll be service revenue. And so you'll see this happen. Now this is for the month of October 2017. So all of the revenue since the time they were open, say on October the 1st, through the time they closed for business October 31st, this is how much revenue came in. This is the amount of tours they sold. Revenue is earned, meaning they've already done the work. Okay. If you have to say what revenue is, it's you've sold something to the customer, you've already earned the money because you've already sold or delivered what the customer was asking for to them. And so that's very important to understand. And so the revenue is listed on the right side in the far column indicating the totals. The next category on the income statement, as you see, are expenses. Now, expenses are just a broad name of a category of account. You'll never ever look at a chart of accounts in a business and see just expenses there. That's it. That's the only word you'll see. No, you'll see specific names of expenses because we have to label exactly, as best we can, exactly how we use the money. Okay, what the expense was. So the fact that we have a salaries or wages expense tells us specifically that that particular expense was to pay salaries and wages for the month of October. Okay, that's it. That's all that means. Okay, doesn't mean anything else. And so it's a very specific way of categorizing expense. We can't have just we can't use the word miscellaneous because that's like a cop out. It's like miscellaneous. What did you use the money for? Can't you label it? You know, that's how specific accounting has to be. We have to try our best to label exactly what we use the money for when we have these accounts. Rent expense. This is specific money that was used to pay rent for the month of October. Most businesses rent their space. So, and I know you've probably been to the mall, not that you're missing much, but nonetheless, every business in the mall is renting that space from the owners of the mall. So that means that every single business in the mall has a rent expense every month because they're paying rent by the month. That's very true. A lot of doctors' offices, they usually rent their space. A lot of them don't own that stuff. They just rent it out through these office buildings. And so this is a very common expense, but $900 of rent was used in the month of October to keep this business open. And so that becomes an expense. Okay. It's important to understand what each of these accounts mean because in order to understand accounting, we're learning about the accounts. And so you'll get more familiar with these as we go. but I want to make sure that I make sure everyone has an idea. So I'm going to be discussing supplies, depreciation, and insurance when we get to the balance sheet. And once we use up those assets, they become expensed. So you'll see the connection between the two in just a couple of moments. Interest expense is very interesting. Okay. What interesting? So anytime a business has a loan and they pay interest on a loan, the interest they pay on any of their loans is considered an expense, cost of doing business. Not the loan itself, just the interest on the loan. And so any amount of money that is interest on a loan that falls into a specific month can be expensed for that month. Okay, and I will show you how that works as well when we get to the balance sheet, because all of these supplies, depreciation, interest, and insurance expenses are all related to information that we'll see on the balance sheet. Notice the total expenses are provided here. These are the individual expenses, and the total is provided here. The difference in revenue and expenses is the profit. Notice that the profit, which formally on an income statement is net income, is simply the excess revenue. That's why it's important to keep, to price your goods accordingly, because the prices of your goods is what you're selling to customers. Customers are giving you the prices that are on your product. That's your revenue. That revenue has to cover all your expenses and give you a profit. So making sure the prices of your products are appropriate. They have to cover all the expenses, and they have to provide you with a profit. Okay, that's how important revenue is. That's how revenue is related to prices. The prices you and I pay for whatever we do at whatever store we go to is the revenue to the store. Okay, and that's a very important piece of information that you need to keep in mind as we go through. So in this case, the net income is $2,860. That's the profit, again, net income. That's the profit of the company. That's the earnings of the company for the month of October. Remember those three words, interchangeable terms. Net income, profit, earnings, interchangeable. They all mean the same. You are the owner. You are one of the stockholders of Sierra Corporation, and your business just got a profit for the month. What do you want to do with that? Well, most owners, as you know, want to keep as much of it as in the business as possible. And so if you want to keep in your profits, so earnings means profit, which means net income, this number here. Right. Retained is how much of those profits you are keeping in the business. Well, what else can happen to profits? They can be shared with the owners in the form of a dividend. So dividends are simply a portion of the profits that are sent to the owner's personal accounts. So they are taken away from the corporation. They're given to the owner's personal accounts. Okay, it's no longer the corporate money. It's now personal money for the owners. And so that's why you see them subtracted on the statement. This is a brand new company. Sierra Corporation it just started. And so it didn't have an income statement for September. It only has an October is its very, very first income statement. So the beginning balance from October 1st is zero because this is a brand new company, fresh out of the box. Mm-hmm. We're adding the profit, the net income or the profit is added to the retained earnings. We subtract out the portion of those that was shared with the owners in the form of a dividend. The ending balance is the amount of the profit that's been retained or kept in the company for reinvestment. Okay. And so that's That's a retained earnings statement. Notice that the period of time from the income statement and the retained earnings statement are the same because the retained earnings statement is dependent on the income statement, and it tells you the story of the profits of that period of time. So it can't be a different period of time. It has to be the same period of time. Okay.
May I ask a question?
Of course, anytime. Just interrupt anytime.
How often are dividends paid out? Like, could they be paid out quarterly, but then like they divide it monthly for payments technically on like the payment sheets?
Normally speaking, dividends are paid on a quarterly basis.
Okay.
Okay, normally speaking. That doesn't mean that there can't be special dividends or special schedules to do something more than quarterly, but traditionally speaking, as the clock works, so to speak, it's been quarterly.
Okay.
Okay.
Cool. Thank you.
You're welcome. And again, anybody that has questions, you have a couple of options. You can go ahead and type in at the bottom of your page, or you can also just kindly interrupt and say you have a question. It's totally, I mean, this is your class. It's very important that you know this. So the retained earnings statement, the actual retained earnings account is an owner's equity account, stockholders' equity account, right? Because who owns the profits of the company? The owners do. So retained earnings in and of itself is an account for the owners. And that's why you see it here underneath stockholders' equity. Stockholders' equity has two accounts that are common. So one is the common stock account, which represents at the very beginning of the company, right? The owners are putting cash in, they're getting shares of ownership. Well, those shares of ownership is what common stock is, right? So common stock is always first because it's the very first thing that happens. In order to actually create a business, you got to put money in exchange for equity. That's how they work. So common stock happened first. It happened to start the business. Shares of ownership were issued first because that's how the company got money to be born, okay? Retained earnings is second because the company has to exist first before it can make a profit. And so it's the second account that's listed under stockholders' equity because it literally happens second. The company has to exist first, has to have revenues, have to have expenses, and have to have a profit. And so, so that's why it's listed second. But this represents the profits of the owners that have been retained, kept in the company for reinvestment. That number comes directly from the retained earnings statement. Retained earnings statement is, it's an easy statement. It only tells you those two things, how much profit is being added and how much dividends are being subtracted, and boom, there's your balance. So as such, it's not emphasized in accounting all that much. It's an important statement, but it's a basic statement. And the only account that you know that goes on retained earnings that you're not going to see on the other financial statements is this dividends account. It's going to be kind of stuck here. Dividends is unique to retained earnings. And so that's the only different account that you need to know. And again, remember what dividends means. Dividends is, it's in and of itself an account in accounting. And it represents the amount of retained earnings that have been sent to the owners, right? Shared with the owner. Okay, so we finished our retained earnings statement, which is for a period of time. And now we're looking at a balance sheet, which is for a specific day. Balance sheets are financial selfies of the company as of a particular day. So as you've seen the balance sheet, this is not BS. Okay, where am I going? I think I should go back to the hospital. Okay, so on a balance sheet, what you have, balance sheets start off by telling you about the company's resources that it owns. And assets are just that. Assets are resources that are owned by the company. The reason that they have these resources or these assets is really two. big reasons. One is they need some of these assets to pay their bills. And the other part is they need these assets to sell their goods and services, whatever business they're in. And so that's the purpose of having assets. The whole real purpose of having assets is either to make sure you're able to pay your bills and that you have money to sell whatever products or services you're selling. And that's what your assets should be pointed toward. When people say, let's reinvest the profits into the company, that means that they want to buy more assets so they can sell more of whatever it is that they sell, right? So wouldn't it be wonderful if Sierra Corporation reinvested some, the $2,360 to potentially either buy more equipment, potentially open up another store and sell more tours of other areas of California. That's a reinvesting activity. That's an investing activity for a business because it directly will relate to more sales of whatever the company is selling. And so if you can bring more people on tours because you have the appropriate equipment, you're going to be selling more tickets on tours. If you have another site and you're doing tours of other areas that are also picturesque, terrific. You'll be selling more tours. Now you have 2 sites instead of 1. That's the type of reinvesting or investing activities that grow a company. Growth is about selling more of whatever it is you sell. Okay. Don't look at it as anything other than growth means I'm selling more of my products and services. I'm getting more customers, I'm earning more money, I'm making more profits, and I'm growing, I'm getting bigger. I'm selling it to more people, selling more of whatever I do. That's really the growth story in business that you have to learn a little bit about. You'll hear about it all the time. You might have already heard about it all, but this is really important. So let's go back to our assets here on our balance sheet. The balance sheet will show our assets first. And again, these are resources owned by the business. They're used for 2 purposes, again, like to help pay bills of the business. They need that. And of course, to carry out the sales of goods and services of that business. That's it. These are specific asset accounts. Okay, so asset is a broad category of account. You'll never look at the books of a company and see just assets. It's like, because they don't, what does that mean? What is it? But you will see a cash account. You will see an accounts receivable account on the books. You will see a supplies account. You will see prepaid insurance account, and you will see equipment. Those are damn sure you'll see those on almost every single business that you look at. So what are they? Well, cash is their main bank account. So when you set up a business, you'll open up a bank account, you'll do your checking. Remember, you could have, in many cases, more than 1 checking account. You'll have a checking account for payroll. You might have a checking account for specific general expenses, et cetera. And so whatever monies that you have in the bank technically is cash. You might have some cash in the business itself that would be part of that. But for the most part, most of your cash is going to be in your bank accounts. Accounts receivable. Now the word is telling. An account receivable happens when and it's usually a business to business deal. One business sells its services to another business and they agree to receive payment later. Okay. So in this case, Sierra Corporation, they do tours. So they might have agreed to do tours for one of their local businesses. And they said, okay, you can pay us later. Here's a bill, here's an invoice. So they're waiting to receive money on the account. They've already performed the service. They've already did the tours. Now they're waiting to receive payment on those tours. So accounts receivable is about waiting to receive payment for work you've already done. How long will you be waiting to receive that payment? Well, most accounts receivables are expected to be paid within 30 days. Okay, so accounts receivable will eventually turn into cash because that's what you wanted when you did the work in the first place. All Supplies are in, it's an,
May I pause you again for another
of course,
second? I'm sorry.
absolutely. No, no.
Okay, so for accounts receivable, you said it would be business to business, but could it be like person to business? So
It's
like,
unlikely. I mean, I don't know. I mean, has anyone had the experience of just walking into a store, grabbing what they want and saying, "Oh, can I have a?" You could just bill me for it. No, I mean, it's not usually what happens. You might need to put a credit card down, but that's cash to the business.
okay, so what would a credit card then fall under? So
Cash,
like
cash.
the cash.
Mhm.
Okay,
Because a credit card is a loan for you, but
yeah,
it's not. They're forwarding the cash to the merchant.
okay,
So the merchant is getting the cash. So credit, and I think that's one of the mysteries too out there is, well, when I use my credit card, that's the same as a receivable. No, the merchant is getting payment for that from your bank that issued the credit card. You're getting the bill, but
yeah,
they're getting the cash minus a fee for being part of the network, whether it's a Visa or MasterCard network. They pay fees for that, but that's okay. They're still getting the cash. So it's unlikely that you and I as individuals can walk into a business, take stuff out of a business without paying. Um, so that's why, but it's very common for businesses to do that with other businesses.
okay,
So for example, my dad was an electrician when he was working years ago, and he worked for a big company, but he also had his own little electrical business on the side. And so he would do a job and he would go to the local electrical supply store and buy all of his stuff. Well, they got to know him as a regular business. So they said, "Oh, well, Roger, whatever you need, you do this and we'll give you the bill and you can pay us later." That's a receivable for the business. That only happens usually with business to business. I can't think of any examples today where that happens to individuals.
okay,
Okay,
thank you.
you're welcome. Okay, so back on assets, we have supplies. Now, there's a difference because there's another account that's listed soon that you'll see in chapter 2 called inventory, and that's different than supplies. So supplies basically are things that the business might need to help them deliver their services to the customer. What I like to use that a lot of us have already experienced is stopping by your local Dunkin' or Starbucks for a cup of coffee. What you're actually buying there is the coffee. Now, the delivery system that they use to get the coffee from their pots to your car is a cup and a lid. So the cup and the lid is a supply. They don't sell cups and lids alone, although I guess some people were saying that Starbucks will sell you a cup for $0.25. Good for them, but nonetheless, that's not their main business. The reason that they have all those cups is to deliver the liquids to their customers. So the cups and lids become supplies. Supplies, when you buy a whole bunch of cups, they're yours. They're your asset. So Dunkin' Donuts will have thousands of cups and lids that they're going to put on their balance sheet as supplies. They'll also do that with all their little wrappers and their bags and stuff like that. All of those would be supplies, because when you walk in and you order a bagel toasted with something on it, they're going to wrap it up in a foil, put it in a bag and with some napkins and give them to you. All those are supplies. You're actually buying the bagel. You're not buying a bag with napkins and wrapped in foil. So, the supplies help businesses deliver stuff to the customers. And so that's really what supplies is. That's different than what I mentioned before. Inventory is what retailers have before they sell you the stuff. So when you walk into a retail store, whether it's Walmart, Target, or any of your stores at the mall, you're looking at a whole bunch of merchandise for sale. Well, the store had to buy that first before they sell it to you. And so that's their inventory. Some people confuse inventory with supplies, but they're very different. Once you've used up those supplies, and this is how it's connected to the income statement, once you've used up these supplies, you can expense what you've used. So for example, I have 1,000 cups, right? I think if I'm not mistaken, some people that I've had in class that have worked at Dunkin' before, I think they actually do a weekly count of their cups.
They do.
Okay, great. Thank you. Thank you for confirming that. Um, and so basically, if you started with 1,000 cups and you have 200 cups left, then the assumption is you've used 800 of those cups as supplies. And so you can expense those 800 cups. Okay. And so supplies starts as an asset, but once you've used it up, you'll see it on the income statement as supplies expense. So that's one of the connections I want you to see. You'll see supplies on the balance sheet. That's your asset. Once you've used them, you'll see it turn over to supplies expense on the income statement. That's an important observation for you. Prepaid insurance is listed here. This is always interesting because I'm like, well, if I buy an insurance policy, because you could buy, car, if you had a car or a truck, a delivery, if I have a pizzeria, I have a delivery truck, I'm going to need insurance on the truck. I'm also going to need business insurance. Well, if I buy insurance for my car or truck, I guess in New York, you can buy it for either 6 months or a year. Is that right? So I'm buying it today for the next 6 months. So what do I call that when I buy insurance today and I'm going to use it for 6 months? It's my asset. So prepaid insurance basically is the insurance that I have paid for that I haven't used yet. Okay. And if I'm buying an auto policy for 6 months today, I haven't used 6 months of my auto policy today. It's my asset. In fact, I can sell it back. It has value. I can cancel the policy and get my money back. So it actually has some value. So it's actually an asset to start with. Now remember, income statements are done on a monthly basis. And so every month they'll look at their they'll look at their insurance policy and say, okay, did we use up any of our insurance this month? If the answer is yes, we've used up this much insurance this month, that's what you'll see on the income statement as insurance expense. The amount of prepaid insurance that has been used. Once you've used it, you can expense it. Generally, that is a good saying to also learn. Okay. So prepaid insurance is an asset until you've used it, then it becomes insurance expense. But again, you can only use insurance 1 month at a time because that's when we look at our revenue and expenses, is every month. And so we have to measure it month to month in this case. Drugs are bad. All right, the last is, on the assets, equipment. So, and this is a broad category because it could really mean anything. Like I said, if I had a pizzeria, I had a delivery truck, I can put that as in my equipment account if I wanted to. If I have a pizza oven, that's equipment. So I mean, it's a broad category. I don't like how broad it is sometimes, but this is how they introduce it to you. It gets more specific as you get deeper into accounting. You'll learn more these accounts. But equipment basically is a long-term asset. Long-term in accounting is anything over a year. So whatever equipment that this company, Sierra Corporation, uses for its tours or its stores or whatnot, is something they plan to use for well over a year. And so equipment is usually listed last on the assets. Assets have a pecking order that you're going to be learning about in chapter 2. A certain order to the balance sheet that's very important that you'll learn in chapter 2. But right now, this is good enough for you. So equipment, these are long-term assets that are used in the business, have a physical quality to them. And as we say, we have I'll go back to my pizzeria since I'm hungry. I bought a pizza oven and I plan on using my pizza oven in my pizzeria for 15 years. Okay, That is a piece of equipment that's going to be a long-term asset to my business because I'm going to be using it for 15 years. Okay. Well, I'm going to be using a portion of its value to generate revenue, right? I'm going to be cooking pizzas and I'm going to be selling those pizzas. Pizzas is my revenue. The oven that I'm using is part of how I'm generating that revenue. So every time I use my oven over that 15-year period of time to pump out my pizzas and sandwiches, I'm using up a certain value in my oven to produce the pizza that I sell. So when you have equipment, the same is true for buildings, you are going to be able to expense a very small portion of what you use in the form of what we call depreciation. So if you go back to the income statement, you'll see a depreciation expense is listed. Well, depreciation expense comes from the portion of the equipment that your company is using to generate the revenue. But again, it's a slow drip. Depreciation is a very, very slow drip because most of the equipment you're going to buy, you're using for a long time. Delivery truck might be 5 years. Like I said, a pizza oven might be 10 to 15 years. A building might be 30 or 40 years. And you're going to learn specifics about depreciation up in chapter 9 in Accounting 102, where you're actually going to be performing it. But nonetheless, it's just how we expense some of our long-term assets in this category. But it starts as equipment, which is an asset. But after we use it, right, then you'll see it show up on the income statement as depreciation expense. So look how many things ended up on the income statement as an expense that started as an asset, right? Supplies, prepaid insurance, and equipment. They start as assets, but after we use them, you see them show up as expenses on the income statement. Okay, important. All right, total assets are here. Okay, total assets are here. That's simply adding all the asset values down. $21,910 of assets for Sierra Corporation on October the 31st of 2017. So you know how it works. If you have $21,910 of assets, you've got to have an equal amount of liabilities and stockholders' equity, because that's how it's a balance sheet. And as I told you, that's not BS. Okay, so let's take a look at our liabilities first. Liabilities are listed first. And remember what they are. Anything that the company owes is a liability, technically speaking. That could be a debt. And it could also be, you can owe a customer something. You can owe employees something. You can owe the government something. I mean, there's a bunch of things that you could possibly owe. And so they'd be listed under liabilities. Liabilities start off, and there's a certain pecking order to liabilities as well. It's not as structured as assets. And again, you'll learn those details in chapter 2. But the first one starts off as a note. Now in accounting, when you hear the word note, you think loan. Notes are a little bit different how they work in the business. Loans, as far as notes are concerned, work a little bit different in the business field than they do personally. When you and I get a loan, we're thinking, okay, I have a monthly payment for the next, God knows how long, right? That's not how notes work in business. Notes payable, a business will get the loan up front, the amount of money up front, and they will pay it back on its due date with the interest, okay, with the interest. And so notes tend to be, most notes tend to be short term, which means they're less than a year. So there's 3-month notes or 6-month notes. They tend to run a little bit on the short side. And again, the loan is paid out to the business right away, and they pay it back on the due date with interest. That's how notes work. Okay, so notes payable, you'll see the word payable. Liability, one of the common words that you'll see, payable, 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 payable. It's really kind of quite annoying, more annoying than what I just sounded like there. And so if you see the word payable and you guess liabilities, you'll probably save your life. Okay, because there's a very good likelihood you're right. And so notes payable simply means it's a loan that's payable. And accounts payable is any bill that's due within 30 days. So let's say you're in your office and the mail comes and you open your mail and say, shit, I owe the Central Hudson $100 this month for electric. It's an accounts payable. An accounts payable. Simply a bill you got to pay the next 30 days. And so that's how simple it can be. Unearned service revenue is one of those interesting liability accounts because it doesn't use the word payable, as you see. So it's not as annoying as the other few. But what is it? What is it? Well, it has the word service revenue in it. Shouldn't it be a revenue account? What's it doing here on the balance sheet? Well, because of the first word, unearned. Revenue is earned. If I see revenue on the income statement, that's been earned. I've already delivered the service or I've delivered the product to the company. I've done the work, it's earned. This is a liability, which tells me I owe the customer something. In other words, I didn't do the work or I haven't delivered the good to the customer. And so it's sitting here as a liability to remind me that I owe the customer. Okay. Unearned service revenue means that in this case, the customer has paid me $800 up front. Now again, I'm Sierra Corporation, I do tours. So it looks like I owe some schmucks $800 of tours because they paid me up front. Okay. So this is interesting too. Once I actually do the tours, I actually move the money out of the liability account and I put it on the income statement under revenue because revenue means I've earned it. I've done the work. This, I haven't done the work. I owe it. But once I do the work, once I actually give these tours that the customer paid me up front for, now I can move that money over to revenue. So I'm going to move that to the income statement. Notice how many times I've mentioned so far the interaction between accounts that start on the balance sheet and end up on the income statement. That's something you have to be aware of because you're going to see those relationships in all the statements. That's why I said spend as much time as possible making sure you get these statements down. Okay, did I just lose? Can everyone see the PowerPoint slideshow again? Or I just lose you with that wily thing? Can everyone see the PowerPoint slideshow?
Yeah, we can still see the PowerPoint.
Okay, I just got a message from Wiley. I clicked on it, it switched screens on me. Got me all ruffled. Thank you, Michael. Okay, so those are important. Those are important. All right, so the next one here, it's important to understand what salaries and wages payable is. Again, the fact that it's a payable means that it's a liability. So I owe salaries and wages. So how would that work? Well, this is a very common account actually. Because let's say you get paid every Friday. Now, do you get paid Friday for the work you just did this week? Anybody? Is that how anything works?
You usually get paid the following week.
Okay, so you do the work, and then you have to wait, right? You put your payroll in, you put your pay stub in, whatever, and you wait. They pay you on the next payroll, right? Well, that means that they owe you the money. So the next payroll that they owe you is salaries and wages payable. They owe you that money. Right? So it'll show up right there. Interest payable is one of those interesting things. Oh, sorry, really bad. This is actually also linked to the income statement, if you can believe it. As I was telling you, notes tend to be short-term, where you are paying, you get a note, it's going to be due in, say, 90 days or 3 months. You're going to pay that with interest at that time on the due date. Well, whatever interest has happened on that loan in October, you can expense in October. Whatever interest happened on that loan in November, you can expense in November, because technically that's when the interest was applied. And remember, interest on loans is a cost of doing business. That's why it can be expensed. Okay. But in the case of a note where I'm not actually paying the interest until I pay the loan back, I'll expense the interest for my month of October and show that I'm going to owe it or pay it later on. So that's where I get the payable. Okay, does everyone see that? All right. I'm hoping this makes a little bit more sense. Really is. All right, notice that liabilities are totaled on the right side here. We already went over the stockholders' equity accounts, common stock and retained earnings. They're added up and totaled here. And the total is put below. And as you see, the total liabilities and stockholders' equity of $21,910 equals the total amount of assets as well. Okay. All right. So I'm going to go ahead and stop the recording here, bring us back to